Hello and welcome to our discussion on the calculation of economic value added. In the previous session we saw that when there are no accounting adjustments, EVA is no PAT minus capital charge, and no PAT is PAT plus interest minus tax benefits, and capital charge is the weighted average cost of capital into the cost bearing funds. But in this session we'll pick up some accounting adjustments, and the accounting adjustments, let us take the concept of deferred tax and see how the deferred tax affects the calculation of EVA. So in the previous session we saw with this balance sheet we calculated the EVA, but you can see that there is no deferred tax, no information on deferred tax, and the profit is given. We assume that no deferred tax. So EVA was negative 22,000. In this session we take up another exercise where there is a balance sheet given and some transactions are given, unlike the previous one where the transactions are not given but the profit was given. And in this session some transactions are given. So with this balance sheet, with this transaction, first we will prepare the financial statements, then we calculate the economic value added. So the opening balance sheet is given like this, and there are certain transactions. The transactions are sold entire stock for cash, expenses paid, purchase plant, and depreciation for accounting and taxation at different rates. So when there is a sales of the entire stock was sold for 300,000, entire stock was sold for 300,000. The sales is for cash. The opening cash in hand is there 282,000, and since entire stock sold, so the cost of goods sold is 64,000. The expenses for the period is 25,000. So expenses for the period 25,000, and let us assume that we paid the entire expense, no outstanding liability. And during the period there was a collection information. There's a collection from the old debtors, and the collection from the old debtor was 100,000. Collection from the old debtor was 100,000, and collection is an inflow, not an income, but a reduction in the debtors. So the debtors will reduce to the extent of 100,000. Interest on the loan, so interest on the loans 0.08, and interest on the short-term loan is 0.10, and let us assume that we pay the entire interest during the period whenever it is due. So interest is paid. Depreciation for accounting is what's given. Depreciation for accounting is straight line, but before that let us see that asset has been purchased. The asset has been, a plant has been purchased for 250,000. So plant purchase is a cash outflow, and plant will appear on the balance sheet at 250,000, and we have to charge depreciation on that. Depreciation is shown at 10%, 20% on SLM. So therefore depreciation on it is 0.20, 20%, and depreciation will appear on the balance sheet on the as an accumulated depreciation minus 50,000. So the PBT is 150,000, which is income minus these expenses, which is 146. But to calculate the tax, we have to calculate or prepare the tax statement. The tax statement, sales is the same amount, COGS is the same amount, expenses is same amount, interest is same amount on the loan and the short-term loan, but depreciation, it says the depreciation for the taxation is 50% on a reducing balance method, since for the first time we are purchasing, so the cost will become the base for determination of depreciation. So the total expenses for the taxation is 221,000. So the taxable profit is 221. 300 minus 221, that is 79. Observe this, the taxable profit is not same as the accounting profit because of the depreciation, and the depreciation in one case we are following SLM, in other case we are following the WDV. But the tax is calculated on the taxable income, and according to the accounting standard, that tax is shown as a current tax. But whenever the profits of the accounting is not same as the profit of the taxation, we have to calculate the deferred tax. The deferred tax is a tax on the timing difference, and the timing difference is a depreciation here. So therefore deferred tax in this case is 22,500. Let me recap. Whenever the accounting profit is not same as the tax profit, the current tax is and deferred tax have to be shown. Current tax comes from the taxable profit, and the deferred tax is a tax on the timing difference. The timing difference arises due to the accounting assumptions on several items, and one such common and popular items is depreciation. So the profit after tax is 46,000 PBT minus the tax. Profit after tax is 107,800, and this 107,800, if no information is given, we retain the entire profit, which is 353,000. The cash in hand, now because you paid the tax, let us assume that we paid 23,600, so the cash in hand is 337,300. So 282, 300,000, 100,000, 682,000 is the total inflow. Expenses is the 25,000. Plant is 250,000. Tax is 23,000. Interest is 7,000. So cash in hand is 376,000. So cash in hand will appear on the balance sheet. The entire stock has been sold off, so no stock anymore. No change in the capital, no change in the loan, no change in the short term, no change in the creditor. But we can see that expenses in the income statement for taxation is more than the payment made, so the excess of expense or the payment will be treated as a deferred tax liability. So the balance sheet tallies. So we converted the set of transactions into the financial statement. So the company is having a positive PAT of 107,800. Now let us find the no PAT and EVA. To find EVA, we have to find no PAT and capital employed. So the no PAT is the excess of EVA is the excess of no PAT over the capital charge. So let us find no PAT. So we'll take the profit after tax, we'll add back interest, and interest is both short term and long term, that is plus 7,000, less tax benefits on interest 0.30. 0.30 is the tax benefits of interest, and since accounting adjustments are there, the deferred tax is not recognized while computing the EVA, so therefore we add back the deferred tax, so deferred tax is not recognized. So the no PAT is 135,200. 135,200. The equity of the firm is 100,000 plus 353,000. The long-term debt is 25,000. The short-term debt is 50,000, and there's accounting adjustment because this is no more and is not recognized, so therefore entire DTL becomes a part of the equity. So this is called accounting adjustment, but that will be treated as equity. So therefore the rate of the cost of equity, we will check what is the cost of equity given, 18%. So the cost of equity will be used to calculate the cost. The cost of the debt is 0.560. The cost of the debt is 0.70 into 8% into 8% into 8%. So therefore okay, so it is 5.6%, 0.70 into 10% for the short-term loans, so it is 7% is the cost of the debt, and the accounting adjustment is treated as the equity equivalent, so will be corresponding cost will be 18%. So therefore when we multiply the rate with the amount, you get the total capital charge, and total capital charge is 90,634, and that is the cost of the funds for using the amount of equity, long-term debt, and short-term debt, and the corresponding accounting adjustment. So EVA is equal to, as we know, EVA is a excess of the NOPAT over the capital charge, and in this case NOPAT is 135,200 and the capital charge is 90,634. But an important point that I would like to stress here, that unlike the previous case where there are no other accounting adjustment except the interest, in this case we have an accounting adjustment like deferred tax. EVA ignores the deferred tax because that is a tax on accounting adjustments, or tax on the difference between accounting and tax profit arising out of the accounting assumptions. So that is added back to calculate the NOPAT. But since it is added back, to that extent the capital employed goes up. As such, we have been discussing in some of other sessions, the deferred tax liability DTL should be treated as a surrogate for equity. So the cost of the fund, while calculating cost of fund, we take equity, we take long-term debt, we take interest-bearing current liabilities and accounting adjustment, and the accounting adjustments are given a name called equity equivalent. Equity equivalent is the adjustment, is the accounting adjustments required to convert the accounting profit into economic profit, the accounting capital employed into economic capital employed. Thank you very much.